14 years, what some analysts estimate could be 675 million ounces. America's most powerful bank. While the world was distracted by stock markets and crypto, J.P. Morgan quietly built what may be the largest silver position in human history. And here's what caught my attention. In late 2024, COMEX data shows millions of ounces were reclassified from registered to eligible status right as silver approached $60. Coincidence? Maybe, but I've learned to pay attention when patterns emerge. In the next 12 minutes, I'll walk you through publicly available data that tells one of the most stunning financial stories of our lifetime. Whether J.P. Morgan is playing the silver market or has become the silver market, that's for you to decide. I'm not a financial advisor. This isn't financial advice. This is pattern recognition based on 14 years of publicly available data. Let's dig in. Let me start with what should make every silver investor pay attention. J.P. Morgan operates COMEX's largest vault network. That's public record. You can verify it on CME's website. They're also the custodian for SLV, the world's largest silver ETF. These are facts. Now here's where it gets interesting. Some market analysts, tracking delivery reports since 2011, estimate their total physical position could exceed 675 million ounces. I need to be clear, the CFTC doesn't disclose individual bank holdings, so nobody, including me, can verify this with certainty. But if those estimates are even half right, we're talking about more silver than entire nations hold. More than the Hunt brothers controlled at their peak. More than Berkshire Hathaway ever accumulated. One institution, potentially controlling a massive share of the world's investable silver supply. But this story doesn't start in 2025, it starts in 2008, with one of the most fascinating financial reversals in market history. When J.P. Morgan acquired Bear Stearns in March 2008, they inherited something interesting. Market observers have long speculated that Bear Stearns held significant short positions in precious metals. Whether J.P. Morgan continued, unwound, or reversed those positions has been the subject of intense debate ever since. Here's what we know for certain. After the acquisition, something changed in the silver market dynamics. The timing was remarkable. 2008 financial crisis. Everyone panicking about stocks and real estate, precious metals prices suppressed. Physical metal available at prices we may never see again. What would you do if you were sitting on the trading desk of America's largest bank, watching governments print trillions of dollars? Now here's where the story gets very real. In September 2020, J.P. Morgan agreed to pay $920 million. Let me break down who was after them, because this matters. The CFTC, the Commodity Futures Trading Commission. This is the federal agency that polices futures and derivatives markets. When you trade gold, silver, oil futures, they're watching. The DOJ, the Department of Justice. Federal prosecutors, the same people who take down drug cartels and organized crime. When the DOJ opens a case against a bank, someone's looking at prison time. The SEC, the Securities and Exchange Commission. Basically the cops of Wall Street. They protect investors from fraud. When all three agencies coordinate against one institution, that's not a slap on the wrist. That's a federal takedown. And the number. $920 million. The largest penalty in CFTC history. Let that sink in. The charges? Something called spoofing, placing hundreds of thousands of fake orders to manipulate prices, then canceling them before execution. They did this in precious metals and treasury markets for 8 years, from 2008 to 2016. I'm not speculating here. This is from CFTC press release 8260-20. You can look it up yourself. The order states that J.P. Morgan traders placed hundreds of thousands of orders with intent to cancel, sending false signals of supply or demand. 8 years. Hundreds of thousands of fake orders, in precious metals. The agency's own words. JPM's illegal trading significantly benefited JPM and harmed other market participants. Now think about this. They paid the fine, legal slate clean. And then what? Some analysts believe that's when the real accumulation began. Here's what market observers have pieced together from public COMEX delivery data. Unlike the Hunt brothers, who accumulated 200 million ounces in just 18 months and attracted immediate regulatory attention, whoever has been accumulating silver since 2011 has done so with remarkable patience. The numbers analysts cite, and again, These are estimates based on delivery patterns, not confirmed holdings. 2011 to 2013, steady accumulation while silver traded between $15 and $35. 2014 to 2016, accelerated buying as prices dropped below $20. 2017 to 2020, continued accumulation through the COVID crisis. 2021 to 2024, strategic positioning as supply deficits emerged. The brilliance, if this theory is correct, lies in the patience. Spread buying over 14 years, never fast enough to trigger alarm bells, never large enough in any single month to move markets. This is the opposite of what destroyed the Hunt brothers. Let me break down exactly what destroyed the Hunt brothers and how, theoretically, someone could avoid every trap they fell into. Mistake number 1. Leverage. The Hunts controlled $3 billion in silver with only $1 billion in capital. When COMEX raised margin requirements from $500 to $30,000 per contract overnight, they faced margin calls they couldn't meet. What if someone used primarily cash purchases, no leverage risk, no margin calls, no vulnerability to rule changes? Mistake number 2. Speed. The Hunts cornered the market too fast. By 1980, they controlled roughly half of U.S. investable supply. This triggered regulatory panic. What if someone accumulated slowly over a decade, never controlling more than could be legally justified as strategic reserves? Mistake number 3. Political opposition. The Hunts were viewed as rogue speculators fighting the system. What if the accumulator wasn't fighting the system but was part of the system? A systemically important institution with regulatory relationships spanning decades. Mistake number 4. Timing. The Hunts accumulated during a period when governments actively defended fiat currency stability. Volcker raised rates to 20% specifically to crush commodity speculation. What if someone accumulated during an era when central banks themselves are buying gold and actively debasing currencies through QE? When fighting the accumulator means fighting the very policies governments are pursuing. Think about that for a moment. Now let's look at what's happening right now. This isn't speculation. These are verifiable data points. Silver price. As of early December 2025, silver hit an all-time high of 59.3 to surpassing the 1980 Hunt brothers peak for the first time in 45 years. COMEX inventory crisis. In the first 4 trading days of December 2025, over 60% of COMEX's registered silver inventory was claimed for physical delivery. Industry observers are calling it a vault drain emergency, LBMA depletion. London's silver inventories fell to approximately 827 million ounces by late 2024, near all-time lows. Of that, an estimated 551 million ounces backs ETFs, leaving roughly 276 million ounces of available float. Backwardation. Silver futures are trading in backwardation, spot prices exceeding future prices. This is historically unusual and typically signals near-term supply stress. Lease rate spike. In October 2025, silver lease rates reportedly spiked to 200% annualized overnight. When it costs that much to borrow silver, something is very tight in the physical market. These aren't predictions. These are current market conditions you can verify. Here's what makes silver different from any other precious metal play in history. Silver isn't just money. It's the most critical industrial metal in modern technology that most people have never thought about. Solar. Each gigawatt of solar capacity requires approximately 20 grams of silver per panel. Global installations are projected to exceed 400 gigawatts annually by 2026. You can't substitute silver in high-efficiency panels. Nothing else conducts electricity as effectively. Electric vehicles. EVs require 25 to 50 grams of silver each for electronics and batteries, roughly 3 times more than conventional vehicles. With EV production expected to hit 30 million units by 2030, that's 25 to 50 million additional ounces of annual demand. 5G and AI, data centers, semiconductors, medical devices, aerospace applications. The Silver Institute projects industrial demand could exceed 1.2 billion ounces annually within years. Supply reality. Global mine production peaked at approximately 880 million ounces in 2015. Current production runs around 830 to 850 million ounces and declining. Here's the critical constraint. 75 to 80% of silver comes as byproduct from copper, zinc, and lead mining. You can't just decide to mine more silver. We're in the fifth consecutive year of structural supply deficit. The Silver Institute reported a 282 million ounce deficit in 2024 alone. Where's the difference coming from? Above-ground stockpiles. The same vaults that are now draining at unprecedented rates. I want to be very clear about what I'm about to say. This is not a prediction. This is a scenario based on historical patterns. What if the paper market breaks? COMEX open interest reportedly represents 244% of vaulted silver. That means there are roughly 2.4 paper claims for every physical ounce. As long as most contracts settle in cash, this works fine. But what happens when industrial users need physical metal, when investors demand delivery? We got a preview in March 2020 during COVID disruptions. Physical silver coins traded at 60% premiums over spot. The paper and physical markets briefly decoupled. What if supply deficits accelerate? The IEA projects that meeting climate goals requires doubling mineral production by 2040. For silver specifically, solar and EV demand alone could consume more than total current mine production within a decade. What if central banks keep printing? Since 2020, central banks globally added over $10 trillion to money supplies. Real interest rates remain negative in most developed countries. These are conditions historically associated with precious metals outperformance. What if institutional accumulation accelerated? Central banks purchased over 1,000 tons of gold in each of the past 3 years, record levels. Some analysts ask, what if certain institutions have been doing the same with silver, but we just can't see it in official statistics? Here's what I see when I put this all together. And I want to emphasize, this is my interpretation, not fact. JP Morgan operates COMEX's largest vault network, that's a fact. Custodian of the world's largest silver ETF, that's a fact. Paid $920 million for 8 years of precious metals manipulation, that's a fact. May hold the largest physical silver position in history, that's analyst speculation. The market, 5 consecutive years of supply deficit, fact, from the Silver Institute. All-time high prices in December 2025, fact. Over 60% of COMEX registered inventory claimed in for days, reported. LBMA inventories at historic lows, fact. Backwardation in futures markets, fact. The setup, industrial demand structurally increasing, fact. Mine supply structurally constrained, fact. Monetary policy inflationary, fact. I'm not telling you what will happen. I'm showing you the pattern and asking, have you seen this before? Several potential catalysts are on the horizon. Again, these are events to monitor, not predictions. Fed policy, interest rate decisions affect dollar strength and precious metals demand. Every meeting matters in this environment. COMEX inventories of registered silver drops below 50 million ounces at current drain rates, the exchange could face delivery stress. Monitor CME's daily reports. Industrial demand, solar build-out accelerates every year. Watch deployment numbers from Bloomberg NEF and IEA, China. Chinese industrial demand continues pulling physical metal from Western vaults. Shanghai inventories and premiums offer clues about global tightness. The pattern suggests we may be in the early stages of something significant. But patterns can break. Past performance doesn't guarantee future results. Markets can stay irrational longer than you can stay solvent. I'll tell you exactly what I monitor to track this story. 1. COMEX daily delivery reports, free on CME's website. 2. LBMA inventory data, monthly updates. 3. Silver Institute reports, annual supply and demand analysis. 4. COT reports, weekly positioning data from CFTC. 5. Lease rates, specs indicate physical tightness. These are public resources. Don't take my word for anything. Verify it yourself. 14 years ago, something changed in the silver market. Whether by design or circumstance, one institution appears to have positioned itself at the center of what could become the most significant precious metals story since 1980. The Hunt brothers were early. They were impatient. They fought the system and lost. If the theories are correct, someone learned from every mistake they made. Someone with the capital to accumulate for over a decade. Someone with the patience to never trigger alarm bells. Someone who isn't fighting the system because they are the system. I'm not saying this is definitely happening. I'm saying, look at the data, ask the questions, connect the dots. If historical patterns rhyme, and I am not saying they will, The next 12 to 24 months could be very interesting for silver. The question isn't whether I'm right. The question is, are you paying attention? This content is for informational and educational purposes only. It does not constitute investment advice or a recommendation to buy or sell any security, commodity, or financial instrument. Individual bank positions in COMEX are not publicly disclosed by the CFTC. Position estimates cited are analyst speculation, not confirmed data. Price scenarios discussed are hypothetical, not predictions. Past patterns do not guarantee future results. The creator is not a registered investment advisor. No fiduciary relationship is created. Investing involves risk, including potential loss of principal. Consult qualified financial professionals before making any investment decisions.